Good morning, everyone. I'm Greg Faranello, head of the U.S. Rates Group for AmeriVet Securities, and welcome to Monday Minutes. Policy decisions this week from the Bank of Japan, the Bank of England. We will be led by the Fed on Wednesday with their announcement and press conference. Chairman Powell, the first Fed meeting since the Jackson Hole Symposium, obviously changes to the Fed's framework coming out of Jackson Hole with a focus clearly on inflation averaging now versus inflation targeting, flexible inflation averaging around 2%, shortfalls in employment, broad and inclusive mandate from the Fed, maximum employment right now. We do expect the Fed to be pressed in general about these changes. Now, keep in mind, there's been a significant amount of Fed speak as expected since the changes in Jackson Hole last month. In conjunction with that, we did get speeches by Vice Chair Clarida, Fed Governor Brainard, two very influential members of the Fed with regard to the policy changes, and in conjunction with the broader committee and the chairman. So we do have some context around where the Fed's head is at this point. In terms of forward guidance, formal forward guidance, the Fed has been very reluctant at this point. They want to maintain, we think, maximum flexibility here through the pandemic as the economy evolves. At the same time, they've also been very reluctant to assign arithmetics around the inflation averaging. What does it mean? How much inflation will the Fed actually target? What should the market be looking at? And with regard to the employment situation, the Fed has been equally clear. No numbers there. They have been explicit that they do think on the employment side there are many factors that influence employment that go well beyond monetary policy, and in fact we agree with that. So this week's meeting will be largely about the chairman being given an opportunity. He will be questioned around some of what we just discussed in terms of more specifics. We do think the Fed will continue to be vague here in terms of what they say to the market, in terms of how they see inflation. What has come out of some of the Fed speak, perhaps, is that the inflation averaging above 2%, the range is likely less relevant. Perhaps the trajectory in terms of where inflation is going would be more problematic in the end. In conjunction with this, we'll also get the summary of economic projections. Last received, it's quarterly, so last received in June. And in normal times, we would say this has taken on less significance with the Fed. But relative to this meeting, it's the first time we'll get the SEP in conjunction with the Fed's new framework. And in addition to that, it will also include, unlike June, it will include 2023. So with a strong narrative here of the Fed on hold for a long period of time, I think the market's going to be curious where the individual members assess the economy in terms of growth, in terms of inflation, in terms of employment, but more importantly, what does that mean now with the new Fed's framework relative to the projection for the funds rate? The Fed will continue to link the economy to the virus as they did at the last meeting, and they put that in their formal statement. There's always the potential for a little bit of a surprise, although we don't expect a big surprise. They could change their asset mix, although we're not expecting them to announce any new asset program at this point. But most of the purchases to date have been 5 years and under. But in general, the Fed, since the pandemic began, and we are approaching just around 6 months, when you look at it, when you look at financial conditions in general, you look at short end rates, if you look at long end rates, you look at credit spreads, the capital markets, both on the debt and the equity side, have had an absolutely extraordinary year in terms of functioning and volumes. You look at credit spreads now, in many cases, back to pre-pandemic levels. If you look at the dollar index, now clearly you look at the dollar index, the dollar's been weakening through this period of time, with the exception of the credit crunch, dollar crunch that we had back in March. Certainly when you look at equities, you can make a case in many instances, in particular NASDAQ, that we've gotten a little bit of froth there, and we've certainly backed off. But in terms of equities, which are factored into certainly financial conditions, we've retraced all of the losses that we've seen through the pandemic. So if you're sitting in the Fed shoes right now, you look at financial conditions, you look at the expansion of the balance sheet, the credit and lending programs, despite the scrutiny they've been given, have been hardly utilized. So most of the balance sheet expansion has really been on the asset side, looking at treasuries and looking at mortgages. Now, certainly there has been discussion in terms of further asset purchases. moving from a period of market stabilization, dislocations in the treasury market that we saw at the beginning of the pandemic, to more of accommodation. But the reality is, whether you bucket it to stabilization or accommodation, what the Fed has done to date clearly includes accommodation in terms of interest rates. Powell has been explicit about that, and financial conditions right now in general are very loose. We continue to see the Fed pushing back to the fiscal side of the equation, which is something we've discussed at length, and we do feel right now what's needed for this economy, what's needed for small and medium-sized businesses is not more from the Fed, it's more from the federal government, very targeted liquidity to help get us through the pandemic, help get us through the rest of 2020 with the hope of a vaccine not too far away. I'm Greg Faranello, and this is Monday Minutes.